Hello everyone, my name is Kevin Nguyen. I'm the Chief Operating Officer for the Elite Mortgage and also ERS Nationwide, which is under the umbrella of ERS. Today we are doing the Module 1, Training Session 2 of 6. And what we covered last training session is how to take or do a mortgage consultation within 10 to 15 minutes or less. We covered the 5 C's, the CIA, and also an introductory overview of the calyx point. Today what we will be covering, and I'll pull up the PowerPoint here for us. Give me a second here. So today is covering the what do you do when you get those documentation? How do you analyze the credit, income, and asset? And I'll put this here. So part 2 is analyzing credit, income, and asset. All right, see you later, Dan. Thank you. So what do we do when we get it? And we call it CIA for credit income. The things that we're going to look for in the credit report, I'll go over with actually 2 live file that we blacked out the information. I think we blacked out most of it, but at a quick glance, there might be some personal information on there. But as professional and... No, I'm not. Okay, give me 1 second here. All right. Oh, I am actually. I did. Okay. All right. So we'll be looking at 2 live files, what to look out for in the credit report, what to look for in pay stub, W-2s, and also tax returns. And then we'll be talking about large deposit in bank statement and any red flags. We'll cover the pencil, which is a, I guess, what do they call it, mnemonic, where it kind of jogged your memory on what to take, what consists of a full loan application, along with the disclosure, when to disclose, and the 373 rule. We'll cover how to pull ABM, what that is all about, property profile, owner search, and loan lookup. So we have quite a bit to cover, and I'm going to go through it pretty quickly. Luckily, this is recorded. You can always pause and rewind, and then feel free to contact me too. For those at home, I'm going to type in my contact information, and for those that are watching the video, I'll display it on here. If you want to, you can reach me here at the office. This is the best way to get a hold of somebody live. If you want to talk to me or get a hold of me directly, the best way is a text message, or feel free to call me. I prefer a phone call. So call me, and if I don't answer, just leave a voice message or send a text message there. If you want to meet me in person, I'm in the corporate office here in South Sacramento on Tuesday, Wednesday, and Thursday. But I'm always available, surprisingly, almost every hour of the day, and then even on the weekend by email and text and phone. All right. But in person, it'd be Tuesday, Wednesday, and Thursday. So let's get to it. We are going to pull up the credit, income, and asset. This one, we were going to do screenshot, but it's quite a bit. So I'm going to pull up the actual file of the live file here. So the first scenario, we have 2. One is a typical simple wage earner that works for a company, and the other one is a self-employed employee. So again, we blocked out as much as we could. But if you do see some personal information, please be professional about it. And we deal with our clients' personal information all the time. Just make sure you don't go out and try to misuse that information. So in this particular file here, we have 3 credit score. We have the high of 807, the low of 781, and a middle of 806. And for those that are not familiar with the credit score, it ranges from 350 as being the worst and 850 as being the best. A majority of the American are within the 680 and 720 range. So you have somebody within that range, that's average. And anything above the 720 is great credit. Typically, most lenders don't reward for having any better credit than a 740. But you do get a little better pricing, typically about 1/4 to 0.5% in basis point, not in rate, if your score is above 720. And then there are even some that will give you quite a bit of, like another 25 basis point in pricing, better pricing, if you have above 800. So these are excellent credit, and we have a high here, 805, a low 774, and a middle 776. Whenever you have 2 borrowers, you use the middle, and you take the lower of the 2. So in this example, even though the middle is 806 and 796, if they were going to give us better pricing at 800, we wouldn't be able to get that because the lower of these 2 middle is 796. And for those that are not familiar, there are 3 major credit bureaus in the United States. It is Experian, TransUnion, Equifax. On this particular credit servicer, this is Advantage Credit. We currently use Clear Choice, and then we also use Old Republic, and most of you do use Clear Choice. But for those that are using Old Republic, we are going to move over to Advantage Credit, which is now known as Advantus, TUS Credit, and we'll make that announcement soon later. Okay. So what we're looking at, and so this report will be very relevant for those using a new credit report, but most of them look and feel like this. You'll have the borrower's information here, Social Security, street address. Make sure that it matches. If it doesn't, the lender will ask you to write a letter of explanation explaining why the discrepancy. Just make sure the borrower signs it and explain the situation. This down here, we usually don't have it at the time when we pull the credit, because typically we get the bare information, the name, the date of birth, the address, and the Social Security number. What you do want to pay attention to, and again, we blacked it out, but apparently I noticed that we didn't do the Social Security number. Please do not use any of this information here. You want to pay attention to these readings, and if you can tell, the reason why I pulled a high credit score is that they have excellent credit. But even with excellent credit, there's also reasoning why their credit isn't perfect. So it would say, the time since the recent account opening is too short. Come on, I mean, they got 800 credit score. Most people are within the 680 and 720. So take this with a grain of salt. It doesn't really mean much, but if there is something that flags maybe a foreclosure or bankruptcy, then you want to pay attention to it. But here, this one is excellent credit. Just read it. I really just ignore it, tell you the truth. I know how to decipher it, and that's what I'm going to teach you today. So down here, what you're looking for is open accounts. These open accounts, and what you're looking for is, I skimmed through, and I'm going to scroll to the heading here. So if you see the heading, it will show the creditor's name, who does the credit belong to, and the code, and we'll go cover the ECOA. So this ECOA right here is the key that you can see. It's on the bottom of every page. So I'm in between page right now. This is page 1 and page 2. So the ECOA code does it belong to the borrower, the co-borrower? Is it a joint account between the two? Or it doesn't necessarily mean that it's a joint account between your married spouse. It could be a joint account with somebody that we're not even aware of. For example, it could be their parent that they co-signed, their grandparents, their children, their relatives, anybody. It could be anybody that they're joint with. Undesignated, I rarely run into that. Authorized user, you will. A good type of authorized user is somebody that has a gas card, and they give it to maybe their son, their children, to pump gas, their teenage children. They would authorize them to use the card, but it wouldn't have any I guess any effect upon the credit score of the authorized user. So for example, if we have all authorized user on this account, their score would probably be none, or it would be an NA for not applicable, or just a base. And by the way, most people, if you're really new with the credit, you will land right about the 680, 720 range if you have no credit or have one type of credit, right? The whose is who does it belong to. So this just states that this is the type of account. So you can have a joint account, and then it would say joint for both the husband and the wife, or it could belongs to the co-borrower. So C is for the co-borrower, and then it can also say B for the borrower. So when you're looking at the ECOA, it will tell you the type. So this one belongs to both of them, or joint with somebody. This one only belongs to the co-borrower. This one belongs to the borrower. This was to the authorized user. And then who is the authorized user? In this case, it's our co-borrower, is an authorized user that doesn't belong to, or actually it's right here, it belongs to the borrower here. So you can kind of see how this works, okay? And feel free, if you guys don't fully understand it, stop me. That way, as I continue, if you're stumped, it's probably hard to grasp the concept of it going forward. The creditor's name will show up here. along with account number. It'll tell you usually a comment that the lender will want to put. Usually on a mortgage, it'll tell you if it's owned by Fannie Mae or Freddie Mac or FHA or VA. Then you'll have the date that the account was opened. This was opened on October 2012, and the date last active is the date that they last made a payment. They charge up the account if it's a revolving account. Last date that they increased the credit limit, whatever the last account of last date of last activity is. You have the date that is reported, and I wanted to let you know that this credit report was pulled in June of 2013. So just keep that date in mind, no matter what date you are watching this video. So this one is relative to this one here on June of 2013. As of June, this is recent because the month before they reported that this is active or current as of May 2013. The balance here is $129,000, or the high credit limit, and then the balance now is at $127,000. So the date that they opened it was October 2012. Roughly about 7 months have passed. The original amount was $129,307. Within that 7 months, they paid down the balance. Now is at $127,989. And tell me, for those of you at home, if you can see this. I can zoom in a little bit. Actually, I will. Let me see. All right, so it's a little bit larger. The amount past due, the month's review. You notice that I did 7 months because I took October minus December was 2, and then I put 5. But really, only 4 months have been reviewed. This will tell you how many months actually the payments start, because with the mortgage, when you do close it and they start the account, it's always at least 30 days before you even make your first payment. So if they close in October, the first payment won't be probably due to December 1st. So you got December, January, February, March, April, and then May. So when they reported this, for whatever reason, they only reported 4. We might have pulled this maybe the day before that they reported, the month before. Who knows? But in this case, it's only showing 4 months. And on here, you'll see the time past due. This will show that if they were 30 to 59 days late, but not quite 60 days late yet. If they're 60 to 89 days, but not quite 90 days late yet. And this will be 90 to 180 or more days. So we call it 30 days late, 60 days late, 90 days late, 120 days late, 150 or 180 days late. Which mine? Thanks. And then the other thing you want to pay attention to is the account being paid as agreed, or is it past due? And usually if they're late, they're currently late. How you doing, Luba? And then so they, if they're like 30 days late, it'll show 30 days late. It'll show you whatever it is here, currently the present status. The next thing you want to pay attention to is who are these, information being reported to. This stands for Experian, TransUnion, Equifax. Not always do all the creditor report to all three creditors. You'll see that down here. This account is only being reported to TransUnion. It's only one creditor. And the reason why the credit scores are different is because they're not all having the same data to analyze to generate the credit score. So because these two creditors don't have this information, that's why the credit score is different. And plus, they do have different scoring models. Okay. Now, everybody speculate how they generate that credit score, but we don't know. If we know it, then we probably simulate it. But within every credit agency, they have a what-if simulator. It's branded by Credit Expert. And in there, they do have somewhat of an idea on how it's calculated, and it's pretty good, in my opinion. A lot of them are actually a byproduct of the actual credit bureau themselves. So they do use that information. And we'll cover that on a different session with the Credit Expert. Okay. So this is a conventional loan. It includes the purchase money first. So this is important, because a lot of times whenever somebody refinances already, and even though they're doing a rate and term and not getting cash out this time around, if it's not the purchase money, the actual loan that was used to acquire the property is considered cash out. That affects your maximum loan to value. It affects your debt to income ratio. It affects your pricing, your interest rate. So it affects a lot, not just the the type of loan program, actually. So if we go through all this here, what I look for in the credit report is the type of credit. If you just scroll down and just pay attention to the MTG, that to us is, it supersedes every type of credit out there. They might have perfect credit everywhere else, but if they have a 1 times 30 on a mortgage, meaning a 30-day late on a mortgage, that would affect their overall pricing and the qualification for the loan program. So pay attention to these mortgages, and because we are in the section of open accounts, there are 3 sections. There's open account, and anything under the open account are all paid on time as agreed. What you're looking for on this column is really, is there any balance? So this column here, and if there's balance, and then you see, you just kind of scroll down, and as I'm scrolling down, I'm looking at the type of account plus the balance, and I'm looking at an auto loan and the balance of 14, a student loan with a balance of this much here. So as I'm scrolling down, if there's a balance but no payment, then we got to manually figure out what that payment needs to be. A lot of time that you'll see a 0 monthly payment with a balance is on a student loan. Whenever it's a student loan, you need to instruct your client to call the creditor, the student loan creditor, and ask them for a repayment schedule after deferment. Because deferment is subject to either you're in school full time, 6 months after you graduate. I mean, there's stipulation. Eventually, you got to repay that debt, and we need to figure out within that, because usually a mortgage is 10, 15, 30 years long. I'm pretty sure within that time period, that 10, 15, or 30 years, they will have to repay that debt, the student loan. Okay, so you need to figure out what the payment's going to be. In the past, we were able to omit the student loan, if it's in deferment, but now usually we want to see the payment because it does affect the debt to income ratio. So imagine like somebody who goes to medical school and they rack up $200, $300, sometimes $500,000 worth of student loans just to get their graduate degree, their medical degree, the MD, right? So when that comes out, we're not talking about $100-some month payment. We're talking about probably $1,000, $2,000 a month just to pay off that student loan. So it can be substantial enough to affect your DTI, and that's why we want to get that information. So as I'm going down, I'm looking for mortgage, any student loan, or any balance with a 0 payment, non-disclosed payment. I need to figure it out. If you can't get the repayment schedule, you want to just take 5% of the balance. So in this case, if let's say we didn't have the 130, and I'll pull up the calculator here, I would simply take 3418 and times it by 5%, which is 0.05. And my payment would be 170. Most of the time, it's better for you to get the actual payment than to calculate 5%. So it's always better for you to figure out what is that repayment. Okay, if you really want to maximize the qualification for the most cash out on the refinance, or the highest purchase price with the least down payment on a purchase. Okay, so any questions so far? So open is the open account again section is usually all account being paid as agreed, on time, no late payment. Then I want to go down to the next account, which are next type of account, our closed account. These closed accounts are no longer open. They are paid on time, but they're just they're closed. So sometimes you will have closed account because the creditor maybe went on a shopping spree and said, man, I got to stop shopping, cut up the card, cancel the card, but they still have a balance. So you can have a closed account with a balance. So it'll show up here, and it does have a monthly payment. So it doesn't necessarily mean that a closed account will have a 0 balance or no payment. All right. And down here, you do want to see if they have if it's a mortgage, if it's tied to another property that might be owned free and clear. That would help you find out if it is. Then you also have the next section, which is the one that you got to pay attention to the most. This one, in this case, we probably won't see anything, but under derogatory credit, you would want to write down an explanation for every single type of derogatory account. It doesn't matter how old it is. You want to get it from your borrower to structure your loan, because if the underwriter asks for it, you're fully prepared. Most of the time, though, the underwriter won't ask for any explanation if it's 2 to 4 years old or older. Okay, but I just get in the habit of just writing down the explanation, understand their habit too. Okay, And other credit history, you'll probably see sometimes there's judgment, liens, tax, but they most likely will put it under the public record down on the following page. So under derogatory, you can see this here, and any public records such as judgment, bankruptcy, tax liens, or even or student loans or federal loans, it'll show up here. This person has an 800 credit score. That's why I said we probably won't see any type of derogatory credit, and indeed we don't. Scrolling back up to the trade summary, you want to see under the mortgage section how many mortgage is showing up. So they've had 12 mortgages in the past, and right now the current balance that are still outstanding is $292, combined is $295. Now this person has 12 mortgages. You're like, wow, that's a lot of mortgages. But if we look at the past, it's just they usually refinanced it several times. Okay, I just know this client. It's just they didn't have 12 properties. They just refinanced whenever the rate got good. Okay, so you also want to pay attention to the debt and high credit limit. If you have 10 credit cards with $1,000 balance, $1,000 credit limit each, and collectively you owe $2,000, you would be using 20% of your available credit limit. The problem when this number gets skewed is the mortgage. Because the mortgage, if you just got a loan, a mortgage, it would be technically using 100% of the available credit limit, because there is no limit. It's just whatever the original balance was. And so then mortgages will usually show a higher debt to high credit limit. Somebody without a mortgage, you do want to see the utilization somewhat reasonable, maybe 50%, but it's all tied and already calculated into your credit score. Okay, so it's just a summary of what all the credits are. And I want to explain to you guys the purpose of what I'm doing today with all the income documentation, the credit documentation, the asset, is not necessarily to give you a really in-depth kind of breaking down everything, but more or less to look out for red flags. What are you to look out for when you're scanning these credit report, these income documentation, asset documentation? So as the mortgage summary, if there's any late, you want to make sure that is not within the last 12, 24, some will even go 36 months. If it does have some lates within that time period, you want to check the underwriting guideline to make sure that they still qualify. So even if they have an 800 credit score and they have a 90-day late within the last 12 months, they might not qualify. So credit score is not the defining factor to qualify. So the mortgage late will trump everything else. Okay. And that goes with, of course, the derogatory credit, substantial ones such as foreclosure, short sale, bankruptcy. Those three will trump the credit score too. So here is the credit within the last 120 days. Some will go up to 180, some will go up to 1 year, some will go only 90 days, but typically it's at least 60 days that will show the inquiry. Anything that shows up here, you will need to fill out your letter of explanation and submit it with your file, because I'm telling you, you just do most of the legwork up front, your condition list will be shorter. So you can wait for the underwriter to condition it for you, which they will, or you can just provide it up front and be one of the underwriter's favorite loan officer to underwrite. If you get on their bad list, I would say SHIT list, then you're going to probably wait for the longer than usual to get your file underwritten. Okay, so learn how to submit a complete package. At times, some people say, I'm in a rush, I need to get this deal closed within a certain amount of time. Submitting it through underwriting 3-4 times to get a perfect package will probably take longer than had you just done it right the first time around. And you probably would have got your file underwritten a lot faster. Okay, because here's what happened. You get a file that's sloppy, they would have spent a lot of time writing down all the condition. They would hate you to begin with. They'll put the file inside. This is kind of my bad list here. When you submit a condition, like, oh my goodness, the condition is this thick. It's usually a condition is maybe 2-3 pages, maybe 10 or less. So they're like, oh my God, I'll put this, I'll do it later. I'll do these other one, because they're quick. Then when they're working on the file, they have to refresh the memory of what the file is. So they're shifting gears anywhere from 20 to 100 loans a day So they're working with different scenarios, and they got to switch hat, and they could have forgotten one of the important things that you would have mentioned in your letter of explanation. They would have conditioned it. So that's the problem with submitting an incomplete package had you done it more thoroughly the first time around. Okay, so what we teach you is that look out for any inquiry. Make sure you address it up front. Any derogatory, get the letter of explanation. And the other thing you want to address is AKAs, they're also known as, and we'll cover it down below. So when you're looking through these safe scan, the most common one that you'll see is immigrants. So immigrants will come over. Their date of birth is, of course, earlier, and then their Social Security number was issued later than their date of birth. So then it would just trigger like an alert, and this is common. So it just said that Social Security issue and this, but they were born. What do we have the date of birth? I saw it up here. Let me see here. So let me look up here. So this was born in 51. So there's a 10-year discrepancy, and that's why you have that alert. Okay. So down here, this person, the co-borrower, is issued in 67. Sometimes it doesn't make sense when you get issued a Social Security number the other way around. It was issued in 41, and they were born in 51. Then that might be identity theft. Okay, so you want to make sure the date, the Social Security number issue versus the date of birth always is after the date of birth. And this is the state that it was issued in. Any other alert is here. There are very few, but that's the most common one that you'll run into. And down here, you'll see there are also names. You see these names, and we cross it out. But any multiple instances of names, you want to, and see we missed here. So any instances of name, you want to write it down in the AKA section, also known as. Okay? So down here, and the employer, if they are saying they work at a certain company, and it doesn't show up under the employer, you want to ask them why. Why isn't it showing up? You said you worked there for 15 years. They might say, well, it was known as First Marine Real, and now their name has changed. Then we'll write a letter of explanation showing that. So that's one of the common reasons. You're not supposed to give out, and you should not give out a copy of credit report to anybody. Okay. We only use it for our purpose of qualifying the loan. If the borrower wants to see, they do get a disclosure of the credit score, so they do know what the credit score is. But for them, they can always get a free copy of their own credit report. And what you want to tell them is, they say, "Can I get a copy of that?" You say, "You know what? We can't really do that, but I can show you where you can get one for free." Within a 12-month period, any 12-month period, you're allowed to see what is being reported on your credit report by all three credit bureaus. So write this down: annualcreditreport.com. There is another one called freecreditreport.com. That's not the same, guys. So creditreport.com. This one is a credit monitoring service that will, and I'm pretty sure you saw these ads with the songs and everything like that. This is not the same. This will give you the credit score, but it's not free. It's free to get. They'll say this is free, and they'll have you give the credit card information. And after 14 days, we don't cancel to charge you for the monthly service. Okay, so this is different. Do not put the free credit. It's annualcreditreport.com. This is enacted by the Fair Credit Reporting Act. So you're entitled to get a report every 12 months from these credit bureaus. So if you want to see what's being reported, you can technically get one every 4 months by just pulling one from TransUnion, one from Equifax, one from Experian. But the problem with that is, again, not all three credit bureaus, not all creditor report to every three credit bureau. So you can request it here. Okay. So let me go back to the credit report. So do not give your client the credit report. You can, if they said, well, there's some discrepancy on my credit report. I don't know who this creditor is. Showing some erroneous information. So I'm going to look up Westcom Credit Union, and if I go down to the list of creditors down on the bottom, I can go to the W's listed alphabetically, and I can say, okay, here's the contact information for Westcom. You can either mail it to them or call them. and then you can have them remove any discrepancy that you feel is erroneous. Okay? So this is the creditor. You can give them this information, just type it up, and give them their account number and so forth, but you can't. So on this section is what I want to pull up. This, you can actually pull up a copy of the full credit report I'm looking at right here. So you'll see that if they go to https://credit.advcredit.com, they put in this password and the report number, it would actually pull up. So this is used to verify the authenticity of this credit report. It was meant for the lender to pull. Okay? If you read between my line, it is meant for the lender to pull it, but this is a way you can get a copy of the full credit report. I'm not telling you that you can give your client a credit report. Okay, so by all means, do not violate the credit agency report. But if you read between my lips, you can understand what I'm trying to say. Okay, all right. So this is how lenders can authenticate this information. Just don't give it to them here. Okay, all right. So down here, this is the disclaimer. If they wanted to, or the information for the 3 credit bureau, you can go to, or they can write to these and go to these credit report, these website, and dispute anything or communicate whatever they want with the 3 credit bureau. There's always a the disclosure that we send to the borrower to disclose the score. So this is one of the credit score disclosure that we're required to disclose. When you do your disclosure signing packet, known as the DSP, this will generate on our Calyx form. You can have them sign this too. It serves the same, it meets the same requirement. If you ever forget what the website is, it's right here, annualcreditreport.com, and you can always tell them there to go get the credit report to see how this credit score is generated. We don't give them all 3 credit scores, we just give them the middle one that was used to qualify for this mortgage. So there is a question, I'm going to take a question here. Puma asked, Kevin, I was told that if the borrower pays for the credit report, they have the right to a copy of the credit report. You are told correctly if they paid to a credit service provider, a consumer credit agency. We have an agreement with our credit agency, within our agreement with the credit agency, for us to gain access to pull credit for mortgage qualification purposes. We cannot provide it, we cannot give it to them. So what you've heard is that if they pay for it, they can get a copy of the credit report, and what they're saying is they can pay it through here and get a copy of the credit report. But even if they give this to us, the lender, because we're a wholesale lender, will require us to provide a credit report with our contact or our name on it anyways. This is another company's name, it's not ours, obviously, but you'll see. So what you hear is true with some credit agency, but with our credit agency, we would lose our privilege to have an account with them if we do that. The reason why is they're in the business of selling data. They could have made more money selling it to a consumer, and a consumer get charged. They don't get charged the $13 that we charge them. They get charged like $35. So it's like 3 times the amount. Okay, so they want to make as much profit as possible, and that's why they say don't give it to anybody. Okay. Any question on the credit report? And we'll have another example of someone with derogatory credit on the next borrower number 2. So before I continue forward, any questions on that? All right. I'm going to pull up our borrower number 2. And I'm going to zoom in. Let's see. Okay. So this person, not so great credit, but not that bad either. We're at a 601 at the high and a 589 at a low and 600. The reason I'm saying not so bad is that us broker, we can go down to 560 on an FHA loan, 500 if they come up with 10%, whereas most bank, they would have denied this because it doesn't have a 640 credit score. So that's one of your competitive edge as a mortgage broker. We have a lot of niche product, one of them being the scores below 640. Okay. So we're going to go with the 600. This just made the mark to get the pricing at 600 through 619. Have the score drop down by 1 point, they would be between the tier of 680 to 699. Totally different pricing, more restriction as far as loan to value, debt to income ratio, automated underwriting or manual underwriting, and so forth. So we'll go through the open account. Here is the credit, and I'm going to put into perspective again. We pulled this January 2012. January 2012, so most of these will show January or December 2011, okay? As I'm looking through this here, there's only one open and active trade line. That is at a $500 limit with a 179 balance. If you took 179 and you divide it by the credit limit, they're utilizing about 36% of the credit limit. The tiers that you want to keep in mind is that ideally, these numbers will vary. You can ask many people, but I'll pull up a chart for you guys that will help you understand it. If you ever forget, you can go to credit report usage. Let's see here. What's it? Factors of credit report, credit score. So you'll see something like this. A lot of people will show you this. So what you see in front of you is, let me give you a percentage one. So this is what you'll see. A lot of people will tell you, and I'll zoom in here. So, most of the people will tell you that 35% of the credit profile, the score, is determined upon the on-time payment or the late payment. So everybody start kind of at the middle, and the more good credit, the better. The higher the score go up, the worse it goes down. So Credit Repair will sell you on saying that if we just delete all of these bad credit, your score will go up, which is true. But the next step is that once you hit that par, you need to get good credit in order to bring it above that threshold. So that's kind of the premise behind the credit score. And the amount owed, which is the usage, meaning that in our example, keeping the math simple, is that you got a limit of $1,000 and you use $900. You're using 90% of the available credit limit. The threshold that people want you to keep it at is less than 50% is when it start getting dangerous and scores start negatively get impacted. People will tell you keep it under 30 is the ideal. To keep it prime, you use less than 10%, and some would even say 8%. I would advise my clients to keep it under 8%. So for a $1,000 credit limit, they want you a balance of $80 or less. Okay, so that means you're not using credit. You don't need it. You have it, but you don't really need it. So that's where your score would go up. So people with zero balance, but they use it constantly and pay it down, that's a good way to track the payment history. If somebody have a lot of credit with zero balance, they might have good amount owed, versus the credit limit, but they won't have any payment history in order to track that. And you can see the payment history is a higher percentage than the amount owed. The length of credit, if you had an account for 30 years, obviously it has a longer track record of a good pattern of on-time payment. Account mix, they don't want you to have all mortgages, all credit card, all student loans, all one type. They want a good mixture of type of credit. And new credit, when you apply for it, applying for too many new credit within the first 6 months actually negatively impact your account, your score. They just don't know how you're going to repay it. But after the 6 months, it start getting better. So the saying is it's worse than it start getting. What does it say? I forget what it's saying, but I think you guys know what I mean. It's bad, then it gets better. I forget the exact saying. So this is the chart they can pull up anytime. Just type in credit score factors, and it'll pull it up. Okay. There is actually I have a free audio. If you guys want it, I will share it with you guys here. I have a pretty good audio for you to understand it. It's about 35 minutes. I'm actually going to share it with you here. Let me pull this up. I'm going to take a little detour because I'm going to forget probably. So I'm going to share this with you guys on the call right now, and I'll put it in the back office. But what I'll do is this. Okay. So let me know if you guys can access this and download it. I'm going to give it to you guys here. And for those who are here in class, I'll drop it into Google Drive tomorrow. But see if you can download that. It's in your chat box. This is an audio explaining in about like 35 minutes, really good, about what I just explained to you in summary. it tells you so you can get a better understanding of how a credit repair credit profile works. Okay, and then so the illustration what I'm trying to show you is that this person only has one positive credit because all these are zero balance. This one he just opened. He opened like a few months ago, so we only have 4 months reviewed. So that's why the score is so low. And again, we're looking at the reference point of January 2012. So this was reported January. It was opened in just a few months before. Everything here is old. You can see that, again, I'm going to go down to this here. It's showing the reported date is this column here. So this was reported 6 years ago. This was reported 6 years ago. And then besides 3 open accounts, he only has 1 good account. That's why the score is low. So my advice to this client would be to go get some new positive credit. For these closed account, we want to see the mortgage. These was paid on time. And just want to be mindful if they're considered first-time home buyer or not. And you can find out if they have, if they have a mortgage from the last 3 years. Okay. So down here, these are all closed account, zero balance, basically. We're going to skip those. Then we go to derogatory accounts. These derogatory account, you can see that it was foreclosure. And the foreclosure, and you can tell the date last reported was October 2007. We're in 2012, which was five years ago. It was last reported October 2007. Doesn't mean that the foreclosure didn't continue many years on, because that's just meaning it last reported. But without any other information, you have to just go with this and say your foreclosure was October 2007. It's been less than 7 years, so you can't get a conventional loan. But it's been more than 3 years, so you can get a government loan such as the FHA loan. So you need to find out how long the foreclosure is. One thing I want to let you know is that we'll go in a little bit deeper later in this the training regarding the property profile. So we'll look about this, and I'll show you how we can determine the exact date and how we can order additional foreclosure documentation. Okay. So this one is said that's conventional loan, and it's been about 5 years from the 2012. You want to ask them what happened. You really need to type up a detailed letter explaining why it was foreclosure. The story is usually some type of financial hardship, some type of death in the family, or usually a death of a primary wage earner. Maybe some familial, kind of divorce or separation. It's usually something you can explain. What they don't want to hear is that I didn't like the house, so I just let it foreclose. So there's stuff that you don't want to say, and there's definitely stuff that are acceptable. The one time that you can make an exception for conventional loan where it's only 4 years, less than 7 but more than 4 years, is for extenuating circumstances. Their extenuating circumstances is what I described to you: death of one of the borrower, the primary wage earner, or usually like a mandatory military. If you were deployed for military action, then that's acceptable too. And illness. If you can document an illness that caused you to not be able to work, that is also acceptable. So besides those 3, there's very rare cases that you can do less than 7 years for conventional. For FHA, you can have the FHA Back to Work program that you can document a decrease of 20% in income right before the foreclosure, and then within the last 12 months that they've recovered with no late payment, and now they're back somewhat to their income. Then we can do it as little as 1 year for FHA. Okay. For this, we're looking through all these accounts, and we want to get explanation. So this here I'm using is Adobe Acrobat Professional. You can use the free one, and the free one will still have what I'm going to show you. The tool is the comment and markup. You can use this little box called Call Out Tool, and if you just click one here and you click somewhere else, it'll put an arrow and a box. So if I was doing this, I would just explain it, so job relocation, and then I would probably put maybe this explanation here. Whoops. So I'd probably put comment tool. And maybe I have to put this here, and I'll put, loss of 20% of income, whatever it is. And you can, once you type it in, you can always move the box. If that's blocking information, you can move it down like this. So this is good for those who are paperless. You can download it for free, the Adobe Acrobat. Most of you guys already have it pre-installed on your computer. That's the little tool that you can use. And there's also a highlighting tool that you can go here and you can highlight. But it only works when you have actual text. This one doesn't have text. And if it's a picture, then the highlighting won't work. Okay? And we can use this. The other thing is under the comment tool, if you don't need an arrow, you just want to put a box. This is what I do. If it's a picture, I just kind of do this. If I can't highlight it, and I'll put that. Okay? So as you pull the credit, make your notes. If you're the good old pen and paper, print it out and write on it and scan it and give it to your processor. So go through all this, get an explanation for everything that's under a derogatory account. Make sure you understand it, and then when you type up your letter of explanation, you would write a very detailed explanation in one of them, and then for the rest, you just say see, explanation above, see explanation above, and then it'll address all the accounts. But that way, if the underwriter said, hey, what happened to this account, you've already explained it to them, they get it, they don't condition 3 million things that they don't, because they don't understand it. So that's what you want to do. So here's all these foreclosures. So this is one where I don't think there's any judgment we can see here. So this one does have a bankruptcy. What you're looking for in the bankruptcy is it what type of chapter is it? For those, a Chapter 7 is where the debt is forgiven. It's just eliminated, the creditor took a loss, and you wipe the slate clean. I want to say that back in 2009, 2008, or 2010, somewhere there, they made the bankruptcy law a lot harder to file for Chapter 7. So people still do, but it's a little bit, I guess you got to qualify for it. I'm not an attorney, so I don't know exactly what, but I just know it's a little bit more difficult. So the other type of chapter bankruptcy you'll get is a Chapter 13. A Chapter 13 is when the borrower or the person, the creditor, not the creditor, but the borrower, decides to repay the debt. But they can't pay what the full installment amount is. So they would negotiate a debt, and the judge would say, okay, based upon your income, it's reasonable that you pay X percentage of your income. That would reduce your monthly payment from here. But over X amount of years, you would have paid it off. So that's a Chapter 13. A Chapter 13 is more forgiving. If you just make 12 monthly payment, you can, and then the bankruptcy court allows you to go back into go into a mortgage transaction. You can do it in as little as 1 year. Okay, but the key thing is that you need a letter from the bankruptcy court or the judge stating that you can enter into a new mortgage transaction. If not, then you go off of 2 years of the dismissal date. That's where Chapter 13. On the Chapter 7, you can go with 2 years after the discharge date for FHA, and then for the conventional, you do wait for a minimum of 4 years. Okay. So, and then if you guys ever forget on those, what I do is I put waiting period, and you'll notice I do Google a lot, just like most people. Waiting period after derogatory credit. And it's usually the first one. This one here, the one that said real estate marble. I guess if they take it off, we're going to be kind of SOL there. But this is the one I always go to. If we go to the image, actually I'll go back here. If you go to image, it's the first one here. This is the one that I like to refer to. It's accurate. It has, it's all inclusive. Some of them don't have it. So if I zoom in here, you see on Chapter 7, it say if you're looking for conventional, you got to wait 4 years from the discharge, or if you're doing the Chapter 13, it's 2 years. And then, of course, for FHA, the time is a little bit shorter, 2 years after the discharge date and 1 year after the payout period, which is 12 monthly payment. And if you ever are working on VA, USDA, it has that too. So I really like this sheet. We're going to create one for ERS. And then we'll have it in the back office for you guys, okay? So in this case, the status date and the status matters. So if you have something that doesn't say discharge, this date doesn't even matter because it needs to say discharge. Because if you notice, they filed it on August. Sometime the discharge date is like 3 years later, just because for whatever reason. So it's not the filing date that you want to pay attention to. It's the status date is the date that you want to pay attention to. So this is pulled in 2012. It was discharged in 2002. So it's more than that 4 year that we're looking for. So we should be okay. All right. So here's all the inquiries. Again, you want to address all those there. And look at the safe scan, and here is the creditor's name, the code, and the information. All right, so any question with the credit report, how to analyze the credit report, what you're looking for, what letter of explanation you need to write, the inquiries, the derogatory credit, any of those questions? Okay, so So this will lead us to income documentation. So on our income documentation, you will typically have a W-2 earner, a wage earner that, let's see here. So on a W-2, you're looking at, there are 5 boxes that you'll see, or the box 1 and box 5. This income here that I'm going to zoom into, this income is the earning that they actually work and receive, the actual earning. These here will include any perks, any 401ks, any contribution on behalf of the employer, and so forth. What we usually use is the box 1 to be less aggressive. Some lender, as their niche, they would use box 5. So you can check with the lender. We always go with what they truly earn. But because if you have an executive that has very little base salary but a huge commission bonus, depending upon the accounting with the company, it might show maybe $30,000 a year, but $200,000 over here or more, and then that's where you need to find a niche lender that would take this and make sure that they can use it. Okay, so even though your wage, you want to be safe, use box number 1. So that's what you're looking for on the let me go here, whoops. On the W-2, also you want to look at the name. On the name, it needs to match the 1003, the employer. The address doesn't necessarily have to match because a lot of time corporate address will be here, but the one that they work. On the loan application, they want to see the work address where they physically drive to work every day. Sometimes they will hire a HR company to do that. If they do, you need to get a letter of explanation, explain the relationship between the company, the HR company, and also the actual employer. The other thing I want to point out is that you might get 2 W-2s in 1 year. If you do have 2 W-2s, and how the underwriter is going to find out is on your tax returns under, and I'll pull it up here. So let me just go down. So under here, on your tax returns, on usually line 7, and every year it changes, but it will say wages, salary, and tips. And then you get an income of $59,268 here. So I'm just going to put $59,268. And if you only submitted 1 W-2 here, if you submitted that and they did the math, so they minus your $47,246.58, they're like, we're missing $12,000. Where's the second W-2? So they're like, how the heck did they even know there was another job or anything like that? That's how they find out, the underwriter. So you look at this here, and then you'll see the compensation is $12,022. So we're right there at $12,022. So this is the missing income, and that's why we always use the box 1 for the true income, because that's usually what is reported on the tax returns. Okay, not necessarily all the bonuses that they would get on box number 5, or the benefits. So pay attention to all the W-2. Make sure you gather all of them. So just do a quick calculation on that box and see if you do have all the W-2s. And understand the difference why box 1 and 5 are different. All right. What you also want to look here is some W-2 actually breaks this down. Most don't. But if they do this, see if there's any unusual deduction or uncommon deduction, more like it. When I say that is, if you see child support, then you probably want to make sure you include in your debt-to-income ratio. If you see 401k loan repayment, that means they borrowed from their 401k, you probably want to hit them with that too. Because it won't show up in your credit report. If they're not late, child support won't show up in your credit report. The only time it really goes on your credit report is if the county is going after you for repayment. So you want to take a look at this too and find out if there's anything uncommon. Okay. So we're going to go down to the tax returns, and on this tax returns, what you're looking for is how are they filing? Are they filing single, married, and if they're married? We've had this file happen. So somebody filed that they're married, they submitted, but on their loan application they put they're single, but all their tax return for the last 2 years so that they're married. So what they conditioned for was a divorce decree. Unfortunately, the borrower didn't finalize the divorce. They don't have a finalized divorce decree, and then we couldn't do the deal. So you got to pay attention. This can kill your deal too if the ex-spouse is not cooperating, and you can't get them to sign the grant deed because they'll need it if you're legally still married and don't have a final divorce decree. So pay attention to the filing status, because it will affect, and a lot of people will say that, oh yeah, she'll, my ex-spouse will definitely sign it off. Come down to the signing table. In between there, things got ugly somehow, one way or the other, and then you have an issue. Okay, so make sure that they fully aware there. So head of household is the same as single, usually here. And if they have dependent, you can figure out, on your loan application how many dependents they have. What I want to show you here is there's a worksheet you can use, but for wage earner, what you're looking for is just any numbers. If there's a number on the right-hand column, go to the left. This one's a little hard to see. I'm going to try to zoom in to see if you can get it. Let me change my tool. So on here, you will see that it said Form W-2. You see that? It's kind of hard to see, but it said Form W-2. So on that Form W-2, that means because this number here, I need to get the W-2. I'm looking at this number, and I look here, it doesn't say any forms. I go to this number, it doesn't say any form. And that's how you know how many schedules there are to get with a tax return. Some people will just give you the first 2 pages, this up to 1040. And you say, well, I need the other one. So on here, if you look, it said there's a Schedule A. So I look at this number, it said there's a Schedule A. But if you scroll to the left, there's standard deduction too. So for standard deduction, they can enter $6,700 if they're single married, $11,400, or $83.50. If this number was any of that number, I wouldn't ask for Schedule A because it's just a standard deduction. But because that number is different, I would ask for the Schedule A. Okay? So just pay attention to any standard deduction. You won't get a schedule for those. So this number here, I'm going down, I'm going to the left, going down, going to the left, and then I don't see any schedule. So down here, okay, and you go down. And so in this particular case, we do just need a W-2 there, and 1099 if they have anything here. So this is Schedule M, so we need a Schedule M here. There's a Form 8663, you need to get that. So that's just the overall general idea of how you don't need to learn how to do tax return, just learn how to gather all the documentation for underwriting to do their job. All right. So I'm going to go ahead and see if you look at this number. Here's Form 8888. So if you scroll down here, here's the Schedule A. Because he didn't take the standard, we have a Schedule A. Then we go down to, and that's it. Because some of these other aren't really relevant. So if they send you that that's all they got, it's okay. Most of these things we don't need. But the most important thing that I want you to pay attention to are your Schedule B, if we're going to use that income, ordinary dividends. So if they have a lot of investment, they get a lot of interest, and they want to use it as part of their income, we'll need the Schedule B. If they're self-employed, we'll need a Schedule C. If they have capital gains and loss for property they've held for long-term gain, we'll need to get a Schedule D. And then for any rental property or companies, you need a Schedule E. Okay, so these are the most common: Schedule A, B, C, D, and E. So A through E, those are important if they have it. Okay. And all the M's and other things are not so important, but one thing on a wage earner that can kill your deal is this line right here. It's called the Form 2106. If you have a number here, you have to deduct whatever this number is from their earnings. So if their income is $59,000, but there was a $10,000 amount here, their income would be $49,000. What this 2106 is any business expense. For example, police officer, they need a uniform, they might need a handgun, they might need certain things. So that's part of their job. They need it to do their jobs. So if they wrote it off, it's an ongoing expense. So we have to deduct that because it's a business expense to them. Okay. So look out for this 2106. It's a deal killer for W-2 employees. Right. So as you scroll down on the Schedule A, for these, there's really not much. We're going to have a class provided by the mortgage insurance company that will go into very detailed 6 hours class about this self-employment income. We're not going to touch base. I'm just teaching you what to look out for red flags. So I'm going to flip the script and we're going to go to our self-employed borrower. Okay. Let me see here. Actually, no. We're still stick with the W-2, and this one actually is a little bit complicated with self-employed and a W-2. So on this guy, on this one, there are a lot of breakdown. And on this pay stub here, I wanted to show you. Let me just get in here. So as you are looking at this, I want you to understand how to read this earning breakdown. So if you look at the regular, they're getting paid a base. So let me just go back out and see here. Okay, so on here, the regular is paid $22.14, and then their commission is $258 year to date. This is what they have paid. Pay time off. This is what they accrued, the vacation, and so forth. Okay, so you want to look at this here, but what you're looking for is any deduction, such as, like I said, if there's a set 401k loan or 401k repayment, that is actually a debt under description like this. Okay, so we'll cover that. But this is the earnings. So this is the earning side. We'll cover deduction a little bit. So the earning is how are they getting paid, and it's very. If you want to use anything but the regular, there's a way you got to break it down for it to be acceptable. The rule is it has to have been ongoing for the last 2 years, and most likely with probable likelihood that it will continue for at least 3 more years. So you just got to ask yourself, do we have 2 years of history, and is it likely to continue for 3 years? An example would be employment. If you're employed and the company, you don't have any news stating that they're going out of business soon, it's reasonable to expect that they should continue their employment, unless the verification of employment come back and say, hey, they're getting laid off soon or something like that. A situation where maybe the reasonableness isn't there would be that it's a seasonal job or on project base. It'll say that once they complete this implementation of a statewide computer system, then it's over. Then it's reasonable that it's probably not going to continue for beyond a certain amount of time. And if you know that project is going to be complete within about a year, then we can't use that income. But if you know it's building a bridge and it's going to take 5-10 years, then it's reasonable that we can use it to expect it to go for another 3 years. Okay, so pay attention to the type of income. If you want to use commission, there's a calculation for that. I'll show you a simple way. There's a very in-depth way that is arguable, and you can defend your mathematics with the underwriter. But I'm going to show you a way that should work with all of them. Okay, it's a more conservative approach, but if you can get them qualified, then the underwriter won't argue with you on that. If you need the extra income to qualify them, then come see me. I'll show you a more aggressive way. So in this case, we look at the income. There doesn't seem like anything crazy here. You know, they're getting kind of spiffed for these here. So on here, they get a reimbursement and a 401k loan. So this amount here, we need to add it to the debt-to-income ratio. That's part of their DTI now. So we need to add this to 208.28. Auto reimbursement, that's a reimbursement we probably don't need to deduct these here because they're just reimbursing them for those amount. The next thing you want to pay attention to is the pay period. How did they get paid? This one is getting paid every twice a month, so from the 1st to the 15th to 16th to the end of the month. Okay, this check date is on the 14th. The hours that they work, you can look at that, and if we pull out a calculator, and you can see that 48.353 plus 25 hours in that pay period, they work 73 hours. But because they get paid semi-monthly, some pay period are only 9 days of work, some are 13 days, depending upon which 15 days those things land on. So this looks fine right here. Okay. Well, actually, this is available. I'm sorry. So on here, that's their PTO. This one, I guess they just get paid a salary. Okay. There's really not much for us to calculate here. Okay. All right. So look for the type of income. And then also the deduction. Now, how do we use this commission? So I'm going to pull up Calyx Point so you guys can see it. It's going to take a while to load up, but I'm going to pull up another pay stub. I think it's on the other one. So on this one, if we excuse me, if we go to their income on the first page here, you can hit the base income. This is just a summary. The actual income will be on page 2 of your 1003. If we use the base income here, and we know that he get paid semi-monthly, that's twice a month, we can put that amount, which is the 2214.06, and that will calculate our monthly income for us. Is at 4428.12. So once you have that monthly, this is the best way, the easiest way for you to use any overtime, bonuses, commission, anything else that is paid through your pay stub. You would take your 4428.12, which is your current monthly income here. You times it by 12 months. That will give you your annual. So you're at 53,137. You would take your W-2 from last year, and in this case, it's not a good example because he actually switched job. But let's just assume that he was with that same company. Let's see here. So let's just say that, or actually this one is right. So he's with the same company. I would take this wage of 60,000. So I'm going to copy this amount here. If I took 60,858, I minus my monthly now, it's fair to say that this is the amount of overtime, commission, and bonus, and so forth that he would have earned. And this is not factoring that he might have got a pay raise today, so his overtime might have been more for the previous year. So if I took that 77 divided by 12 months, I can safely use the 643.38, and I can put it over in overtime, and I can put that there. So to get that same income, so now if I took this 50,000 or $5,071.50 and I times it by 12 months, I should get what is on my my tax return, and that's what he filed last year. So we can the underwriter will most likely say that's a fair assessment of the overtime. Okay, so if you need to use any income, overtime, and so forth, do that. The first step is figure out their monthly by using this. I don't recommend you guys typing in anything here. Go in here, and even as monthly, choose monthly, and then put the monthly here. That way, the processor can see that you did calculate it, and not just type in a number. All right, and then this here, usually what I would normally do is that if I put any overtime here, I would explain to them how I came up with it. So I just put, so I put 60,000, 858, which is 2000. What is that? 2012. Is that 2012? 2011. 2011, and I put TR for tax return minus. What is it? 57. So 4428, 12 times 12. I'm taking this base here. I get 53. I'll copy this. Minus. And then I just put current base salary. And then I put divided by 12. And so, you could probably put OT, overtime, equals. That way, it helps the underwriter, it helps your processor, so they can agree more or less with how you came up with that. Okay, so if you want to figure out that income, because sometimes you do want to fight and you want to use all the income as much as possible. If you can put common sense or logic behind how you came up with it, I've never failed. Where if I spell it out, they would agree with me. But if you just left a number and they couldn't figure it out, they'll come up with their own number. So my theory is that for every blank answer, people fill in the blank. So don't leave it blank. Put all the loan application completely filled out. Get your letter of explanation. Fill out the overtime, the bonus, and so forth. Okay. So let me go ahead and pull up our. So now. We'll go through this tax return on our single here. This one actually has a self-employment, okay? So he's married, and there's a wage earner plus a self-employment. So what we're looking at is there's a Schedule B, because there's a number here. There's no schedule here, but there's a Schedule C. So there's a negative. So maybe the husband or wife works, and then the spouse is doing a startup business, and so it's taking a loss. Unfortunately, we have to do that too. But there's a pension. So they liquidated some type of pension, or they get some type of a pension. So here is the amount that is non-taxable, and this is the taxable amount that they're getting to. Okay, so out of this 70, they're only being taxed 66. So if we were to really need the difference, we can gross up the non-taxable information. We'll cover that when we, or actually right here. If you see a Social Security benefit, somebody that received SSI for disability, for maybe taking care of somebody, usually it's for a child, you can gross it up if the box is in here. So people ask me, is Social Security income taxable? Or do we gross up every single Social Security award letter? Not necessarily. You need to look at this line. If it shows up here, you do not gross it up. What do you mean by gross it up, Kevin? That means if you make $1,000 in tax, or you get $1,000 from your Social Security, and it's non-taxable, then we would multiply that 1,000 by 1.25. The logic behind that is if you had taxable income, you would be taxed at least 25%, usually, unless you're making less than, it's like a 15%, but on average we said 25%. So in order for somebody to net the same $1,000 that a Social Security person who's not taxable, they would have to earn $1,250, and then after the 25% tax, then they would only get the 1,000. So that's kind of the logic behind it. So you gross it up 125%, and it needs to be here in order to be grossed up. Okay. So here is the pension annuity. So we'll need to see the statement there. If they want to keep using it, we need to show, again, that rule, 2 years in the past and 3 years ongoing. The 2 years in the past doesn't necessarily apply to pension annuity because you might have just reached retirement age at the time of loan application, and then it would still be expected to continue for 3 years. Okay. So here's a non-for-profit rental. We'll probably need an explanation for that. And then we'll go down here. So these are kind of your Schedule A. We need to get your Schedule A. So as you can tell, just go here and look at any schedule there. Okay. And then as I'm going down, I will see the Schedule A. This is the self-employment will play more into the deduction. Unless it says something related to the business, then or the income, we really don't pay attention to it. But this one, you see this 2106. If you see this line 21 and it said 2106, you do want to pay attention to that C statement. How did they come up with this 5523? So on the Schedule A, and that's why sometimes some accounting would put the 2106 up here. Let me see here. So you see this line 24, 2106, some will put here, and others might put it under the Schedule A here. And you just got to pay attention. If they put something here, you just got to see the attachment. So on attachment, we'll get to it here. I don't think they put any deduction. Yeah, I don't think they did. This one is just a standard, and we don't have to see it. If this is 2106, it would have showed up there. Okay. So here's their Schedule C. They only gross receipt of 1153, and probably as a startup. Their expense to travel around was this. The advertising was this. The travel cost, their meals and entertainment was this. Utilities, other expenses. So after all the expense and their thing, they were negative 7,229. So in this case, you would probably omit the spouse that is running this business from the loan, if because all it does is hurt the income, right? So unless we need their asset, we probably won't include this person on the loan, right? One thing I do want to point out is there are things that we can add back to this income. Is you can always add back depreciation. So the full amount, you can add it because it's not a real expense. They're just deferring the taxes till later. So you can add it back here. You can always add back 50% of your meals and entertainment. So I can give back roughly about $546, $47 back to here. Okay. So those are the two things that you can add back. This one's 100%. This one's 50%. Right. So the W-2, this is just another form of a W-2. So if I pull this in here, like I told you on the other one, the other W-2, it actually has a breakdown. This is pretty straightforward. You can just use the box 1, and you'll see the box 5 is usually higher. Just go with box 1. Okay. All right. Any question on the income? I do see. So Jabari, question is, how do I access the ERS Google Drive? There's two ways you can access it. One is you are sponsored through NMLS by Elite NorCal Corporation or ERS Nationwide. How do you check that? Go to NMLS Consumer Source, consumeraccess.org, and type in your license number. So I'm just going to put Elite NorCal. Elite NorCal is the parent company of Elite Mortgage, or DBA of. So when you check your license, what you're looking for is it needs to say yes, you're authorized to conduct business, and 2, that Elite NorCal or ERS Nationwide is representing you, and this date needs to be in effect. This is how you are able to originate loans for us. Your loan application cannot precede this date. Some will allow it to go with the start date here, because even though you switch, it can take up to 30 days for the agency to transfer it. So depending upon the lender, some will let you this, but this is self-entered. This is agency entered. So they like to go with this date because we can tamper with this. We can change it to whatever date we want. All right. So this is the way that I would grant you access to ERS Google Drive. This is the only way. The only exception would be if you're a branch owner. You don't have your NMLS license, but you're a branch owner that's approved to have a mortgage branch, then you would get access to the Google Drive. A limited access to the Google Drive would be for the recruiters. They would have access to this folder only to help them recruit agent. So but in summary, you have to be NMLS licensed and sponsored by ERS in order to get that access to that. Okay. So Jabari, you are there. I will check it and I'll grant you access there. Your second question is forms and advertising that say ERS Nationwide instead of Elite. We have two folders, so that's a good question. If you're under BRE, you would have access to the BRE folder. If you're a DBO, you would have access under the DBO. The DBO would have exact same form, just different logos and different lingos and so forth. Okay. So the DBO right now, what we're doing is we're building out the BRE to be pretty complete. Then we're going to copy everything there and just change out the logo. So everything right now is under Elite Mortgage. It's just because of most of our loan officers that are producing are under the BRE, and that's why we're focused on building this out right now. The other question that you had, let me see here. So Jabari, you said, I do not understand where to see the files. You're going to get a link that was be sent to you once. This is the new process. We just started the Google Drive only about 2-3 weeks ago. So for those that didn't receive the email link, just send an email. I'm going to put it here. Send it to administrative@myequityzone.com. And then just let them know that you are NMLS licensed. They will add you to it. Okay. So the person most likely that will add you would be Diane. And if you need to follow up with her or need access right away and speak to her, you can call her at this number 916-469-3624, and then she'll be able to help you out there. The other question is, I have my license, but I do not form. Okay, download. Well, you need to first get granted access. Okay, Jabari? All right. Okay, so let's go ahead, and we're getting close to where we are. So I'm going to cover the asset part of it. So here is that we're going to go to the bank statement. Now, these are just rules. I can cover pretty quickly on this. These are the bulk and meat of what we're here for. So how do you analyze once you get it from the client? So the bank statement, whoops. Okay, something happened. Okay. So on a bank statement, what we're looking for is large deposit. Large deposit is not defined by a number, technically. Okay, it's defined as anything that is outside of your ordinary income. So if you're a salary wage earner, if that is outside of your normal pay, and it doesn't say payroll on it, then that anything, even if it's $1. In our email, we said even if it's 1 penny, we need to source it. If you can't source it, it's not a bad thing. It's just we're going to have to deduct that amount from your balance. So, for example, if you really needed, your down payment, and you need every single penny, and you put in one deposit, that's like for $100, and now we're $100 short. We're going to be in a little trouble. We're going to either need a gift fund or source it somewhere else, or get another account. Okay, so what we're looking for on this account is that any deposit. Some of them, like Bank of America, I like the Bank of America statement, or Wells Fargo. They'll have all the deposit lumped in one instead of having 2 columns. You got to search for it. So depending upon the bank, you would look at the deposit. So here's the deposits transfer. This one, it said it was transferred from share 1. So we know it's transferred from another account. So now we got to pull up that account. So now we got to ask them, hey, show me the account. And with credit union, they usually have one account. They'll have a different account with sub numbers. So they have checking is 1, saving is 2. Okay, so let's look at account number here. Let me look here. Okay. So it's saying that on this particular savings account 0, you see this account sub account 0, it was transferred from share account 1. I don't think this number was what I was referring to. So disregard what I said there. If I scroll down, you see a checking account is a sub account 1, and then savings account is sub. It'll be -00. So what this is saying that from here, they took from checking and he transferred it to the savings here. if I look at the date of 407 and 421, I'm pretty sure I can find $150 that was transferred. So I'll look at 421. Here it is. So I don't need to source anything because it's on the same statement. The problem happened is when they transfer from another account on another statement. So when you do that, this can happen 3, 4, 5 level deep because they keep transferring one account to the other, and it opens up all kind of a can of worms. So when you pull this up and you know that this is going to be a problem, that their habit is to transfer multiple accounts, tell them to stop doing that. And then don't submit the bank statement to get the loan approval. Wait till you get a statement that stopped the transfer, then submit that account. Because they'll just condition it for it later anyways, for the source of funds, okay? So to minimize the documentation on your client's behalf, pay attention to large deposit and save your client the hassle. What I mean by this is, let's say that this wasn't combined into and it was transferred from a completely different account. You're going to have to keep opening that account and it's transferred, so you'll see it. Once you run into it, you're like, man, I wish I wouldn't have done that, okay? So pay attention to all these transfer, any deposit. So this was easy. We cross-referenced it from the 407, this date here, right here. Now look at this. Here's a transfer to 07. We don't care about transferring out of our account. We don't care how you spend your money. We care about where did you get that money. The bottom line is it money laundering? Did you get that money illegally? That's the premise of what we're looking out for. Okay. So on here, as I'm looking at all the deposit here, there's only 2. I'm okay. So I'm going to scroll down and I'm going to look for any positive number. Here's the positive number, 2979.56, and it said ACH, excess realty, and that's their payroll. So I wouldn't need to source anything. I don't need a pay stub. It's pretty self-explanatory. So I scroll down to the next amount. We've already verified that 150 was a transfer. And then we're going down here. Here's the 200. So it said was a transfer from the shared 00. This was on the 26th. So if I go to the 26th up here, I can see that was transferred. That's 200. Okay, so you want to cross-reference that. Then down here, you see this little $5 here, courtesy refund. If it's a refund, a bank charge, or anything like that, we don't need to source it. It says it over here. Okay, and here's the payroll. So that's what I'm looking for. Again, we don't care how you spend your money, Mr. Barrow. We just care about where you got that money. Okay. So here is the other account. This is 07, and it's a deposit from. So you need to source the $60. Again, we go back up to see the date on the 7th and the 21st. So I would look for $60. Here's my $60 on the 21st. Here's my $60 on the 7th. So that was sourced. Okay. And down here we would here's another account with a different bank. So it looks a little different. One other thing that you do want to pay attention to is non-sufficient fund overdraft fees, anything that shows that they have a hard time managing the money. So if you see NSF, it stands for non-sufficient fund or overdraft. Some will allow up to 1 to 2 or 3 or some, and they have a limit. But if they don't have a limit, they'll ask for an explanation too. So look for large deposit, non-sufficient funds, and overdraft fees. Okay. And also rent. If you guys see somebody on the loan application that type in rent-free, you put rent-free, usually that's when they live with a relative and they're not being charged anything. But every month you see a check being written for $500, then you probably want to put $500 for rent because we can document it. The rule is that if you put anything in here, we need to provide 12 months of canceled check, or we got to verify it through a third-party property management company, and it has to be listed as a business. If they're not listed as a business, they're a private landlord, then we need 12 months canceled check. So what I'd like you guys to do is if you do have a number here, make sure you can track it on the bank statement and look for it. If there is a rent-free, you're also looking for any regular kind of deposit every month for a roundabout number for rent. Okay, so if there's a pattern, you want to check that pattern out. And I'm not asking you to underwrite it. It's just to save you guys the headache, what to look out for. Okay, so these are the red flags. Any question on the large deposit? I'll go over this one here, just one last, let me see here. Oh no, right here. So we'll go over this one. So on here we have the deposit of $48.47, and we have a withdrawal of $57.75. One thing we do want to see too is what is their spending habit? Are they saving? Do they always withdraw more than what they're depositing? So we want to kind of see that too, because if they have a substantial amount in their account, but their spending habit is always spending exactly what they make, how did they save up for that in the first place? So that might be one of the questions. And that's, again, it all boils down to money laundering. Did somebody deposited a large chunk for them to purchase this house and become a straw buyer? Okay. And a straw buyer just means that you're not the true buyer. You're kind of just on paper the person that's buying the home. So on here, we're looking at deposit. Here's a refund. So if it's a U.S. Treasury, they just need to get a copy of the tax refund. We'll need that. I'm looking at deposit. Here's a $300. So we need to figure out what this $300 is for. We're going to go down here, and that's it. So that's the deposit on that account. All right. And I'll go over the other borrower's bank statement. Here's a Chase. So we look at their deposit, $3,200. All the withdrawals, roughly about the same here. Checks paid. Okay. So if the beginning balance is larger than their ending balance, they don't have a good saving pattern. Okay. And it doesn't necessarily mean that, because they could have transferred it to their savings, and it shows as a withdrawal too. So I'm going down here. I'm looking for any deposit. So on here, I'm looking at deposit. Here's 43. Purchase return. That's pretty self-explanatory at Target. Here is a direct deposit from their employer. I have a $37.70 is a purchase return from Banana Republic. Pretty self-explanatory. Now this one I'm going to have to probably source, because it said deposit some weird number. So I'm going to ask them, what happened? Can you give me documentation to show this $471.81? I'm going to go down here. This is the direct deposit for their salary. I'm going to go down here again. What is this $344.50 and $471.81? So that's what you want to look for in the on the asset or the bank statement. And again, if you see non-sufficient funds and so forth, you want to pay attention to that too. Okay. Any questions before I move on to the other one here? Okay. So the pencil rule is this. What is pencil? Pencil is a mnemonic device. It's just an easy way for you to remember what constitutes a loan application. So loan application to me, you basically fill out a 1003 or anything like that. It's just, as long as you, as the licensed loan officer, obtain the property address of the subject property. You got a reasonable value from the estimated value of the property or the equity in the property. You have the borrower's full name. You got their credit, and usually it's the sense of the credit, good credit, bad credit, a credit score. They told you how much income they make and how much they want to borrow, the loan amount. If they told you, and one of the scenarios that I explain to a lot of people is you're at a grocery store and you talk to one of your buddy, and your buddy said, "Hey, it's good seeing you again, Kevin. I was thinking about you the other day. I was going to call you, but since you're here, you know my house, you know where I live, right?" And so he inadvertently gave me his property address because I do know where he lives, and he said, the value got it increased the last year or two, and I think I got some equity. I think it's worth about $350 now. So he gave me the estimated value, and of course I know his name because he's my buddy, right? And he said, my credit's always been good. It's always been in the 750, 800 range. And this year I got a pay raise. I'm making about $150,000, and we're doing good. I want to get some cash out. I'm thinking about maybe getting about $300,000. You think I can do that? Inadvertently, I took the loan application without me even asking them to do anything. So when the idea is if somebody looked at you as a professional, they gave you all this information, they are away applying for a loan. So that person at the grocery store said, hey, Kevin, I'm applying for a loan. So they're expecting a reasonable expectation that you will provide them with a quote, a disclosure. You got to disclose it. So right then and there, I got 3 days, okay, 3 days to disclose to him what the fees I would charge him, what the rate is going to be, what the APR is going to be. So this is so important that you guys understand what constitutes a loan application. It's not what people would normally think. Okay, so that's just one of the example that might happen to you. And then so if you went home and you said, oh, that guy's a jokester, you know, whatever, and 3 days later he calls and report you to the bureau, or for whatever reason, yeah, you would get fined. So it is true. So if we don't know the intention, and you ever hear of mystery shoppers? There are people that does this too, to make sure that you're in regulation, you know, you're in compliance. So you got to make sure you comply and understand that. So that leads us to our 373 rule. When do you disclose? When do you have to disclose? So the 373 rule is after you take the loan application. I come home from the grocery store, and then I'm like, man, I got to give this guy a quote. You know, and I'm like, I didn't want to work on a Sunday, but you know, so now because it's a Sunday, and I'll pull up a calendar. Anyways, it'll be 3 days after the application, and 3 days excludes Sundays and holidays. Okay, so the 3 days would be, and it doesn't matter if you're open 1 day a week or 7 days a week. You would count every day except for Sunday and holiday. So you need to at least provide a truth in lending within 3 days after taking the loan application. So in this example, if I met him on a Sunday, the first day would be Monday, Tuesday, and then no later than midnight on Wednesday, I need to give him a truth in lending. Okay, he doesn't need to sign it, he doesn't need to return it, I just need to provide it for him, and I need to document it. So how do we document it? So if you go into Calyx Point, let's see here. So if I go to Calyx Point, and under my truth in lending, I would just put the date that I disclosed it. How did I disclose it? I disclosed it in person, mail, overnight, and then you just put whatever the APR after you do your initial fee worksheet. It would whatever it would show here, the current, and you just put it here. Okay, so that's how you would track for yourself that you did in fact disclose the truth in lending to that person. So that's how you stay in compliant. All right. The second rule is 7 days after initial loan application is the minimum days that it is required in order for us to close a loan. So if you take a look at it, within 3 days we have to disclose. So if I disclose on a Monday, that'd be day one, and then I can't close until 7 days. So technically I can't close until at least a minimum of 8 business days. Okay, so somebody can close within 7 days if they disclose the same day that they took the application, and then on the 7th day after the loan application they can close. So the 1 week is the earliest that any residential, if anybody say they can close in less than a week or 7 business days, it just can't happen. It's either private lending or hard money or something that doesn't fall under the RESPA, Real Estate Settlement Procedure Act. Okay. Now, if the APR changes by 1/8%, so this is here, right here. In this case, we initially disclosed 4.454. It dropped down to 4.328 because the difference is by 1/8. It doesn't matter if it goes up or down by 1/8, or go up or down by 1/8. You have to disclose. So in this case, if I had to disclose because the difference was 1.25 or more, I have to disclose it 3 days before the buyer can even close. Okay, so we have to disclose 3 days before the actual closing. So that's the 373 rule. Just remember that within 3 days after the loan application, you need to disclose at least the truth in lending. Okay, so provide that truth in lending. You can't close until a minimum of 7 days after you disclose, and then 3 days before closing. If the APR changed, you have to wait at least 3 days. Any question on the 373 rule? All right, you can find this information by typing in 373 rule, and then it'll pop up. This is the first thing that will come up, and it's pretty easy to remember. Okay. So AVM is an automated valuation model. It's a property profile to give you a range of what the price is. We usually run this for refinance just to see if we're within the ballpark. So if I go to appraisal, and then we'll put an address. Let me look here. We'll just go map. And then we're just going to pick a lucky winner. We'll click on one of these random one. So here, we'll pick this one. And I put this address in here. And I get the home value. So in here, the home value here is saying is between 116 and 145. So a lot of people like to use the Zillow value. So they would use this, but we like to use the appraisal because it gives you a range. So if we hit the view more details, it'll pull out, it'll show a little bit more about the property. It's a 3-bedroom, 2-bath, roughly about 1,200 square feet. Is built in, let me see here, what does it say? Actually, so it tells you a little bit of information, but the last date is sold in 2008 for 102. These are the home that sold nearby, and these are the value. So these are here, okay? So we have those. So we use this as free. So just go there. If you're doing a refi, at least get a range to tell your client if it's doable or not. And then the other one we like to use is property profile. Okay, and these are instruction. If you need the instruction, if you send it to administrative, actually send it back off on the Google Drive, it'll give you instruction there too. The property profile is a little bit more intense, so we'll still use this property. And we'll go to, if you don't have access to a property profile, just go ahead and contact administrative. They'll get you connected. Okay. I forget the login, but I think is. So on here is, this is the rep. In case if you want to just call, send her an email, she'll get you set up. So I'm going to copy this for you guys. Put it in there. And you can ask anybody. If you can use whoever you want. But I'll put that in there for you guys. Go ahead and contact her and she'll set you up with a free property profile. On the property profile, this is the more modern one. You can type in. I'm going to show you the classic version. So you can type it in here. It'll kind of narrow in. I'm just old school. I'm going to go to the classic profile. And I'll go to profile here. And I'll put in the address and with the zip code. Whoops. And we'll submit the request. This is all public information, guys. So on here, this is the owner, and this is part. So anybody can go down to the Sacramento County Recorder's Office and request this information. It's just the title company just gave us access to it. Okay. So hit the lender profile. This is what will show up. The mailing address, if it's different from the site is actually the physical location of the property. If this is different, it will tell me that this is an investment property. If it's the same, it usually means an owner-occupied property. Down here, you can again see how many bedrooms, how many bathrooms, how many rooms, the zoning, when it was built, what the square footage, the lot size, and what type of use code it is. Sometimes it's a 2-unit, sometimes it's commercial, sometimes it's mixed use, so you want to pay attention to that. This is the last time that it was sold. It was sold in 2008 for $102,000. It was sold by the bank and to them. Okay. This is the current assessed value. So one of the value that I would base it upon, and this is as of January 1st of this year. So January 1st, 2014, the county is assessing the value at 106,663. We can look here is at 116. I know this is very low amount for you guys in the Bay Area. I just picked a random one. and this, I just click on the loan amount area. Okay, so on here, this is the amount that the county is assessing, and this is what the property tax they're paying. So with this information, when you're doing your calyx point, you can actually on page 2, you can figure out what their property tax is currently here too. Okay. As you scroll down, you're looking for bank information, see if they have one mortgage or two mortgage. When they bought it in 2008 for 1 to 2, they only borrowed $60,000. That means they put $62,000 down to buy that property. Their note is a 30-year note, because if you note that they bought it in 2008, it's due in 2038. You subtract the 2, that's 30-year loan. Okay. Some will have interest rates, some will have a little bit more information, but this here, and if you click on this documentation, it would pull up if the title rep give you access to it. All right. On comparable sales, the general idea is draw a line. If you're printing it out in PDF, you can use the tool. So I'll show you here. If you print, and in Google Chrome, even though it says print, you can save it as a PDF. So there's an option called Save as PDF. And as you save it, if you want the footer, you can. I usually don't like the footer. But in this case, on the property profile, I do, just to see when I pull the property report. Okay. So on here, I would put Save. I'll just put it on desktop, and I'll put Save. So when I pull this up, I go down to my comparable sales. I would draw a line, and this is under the comment line, and I put a line here. I go down 3 months. So we are in May of 2014, so we're pretty close. I would probably go to right about here just to get a base. So these are my most recent comparables. And I want to pay attention to the square footage. So here's the 3 months, here's my square footage. I would probably say if I was buying a house, I would look at something like this. Okay, so this guy here. And this one sold for $145,500. It looks reasonable, 3-bedroom, 2 baths, same square footage, so forth. So if I were to determine the value of this property, and this is fairly close, it would range in between these two, because this is pretty close, between 145 and 192. Because if you look at the year, this one has an extra bedroom, so it would probably fall between these two. And if I go back to my appraisal, the range they have is between 160 and 145. So it's kind of within that range. Okay. So I wanted to show you what the property profile, what we use it for. This showed the plat map too. And that way you can get a good idea of how to determine the value. So don't just go off Zillow, what most loan officers usually do. You want to have an educated guess, and this is how we do it, is take the most recent 3 months. Before, this line used to move down to 6 months. So, we can go down to like something like this. And back in the heydays of 2005, 2007, we go down back a year. So it depends upon the lending market, where this line will go. I recommend that if you want to be safe, do it within 3 months. So 3 months would kind of, right here, you compare those. All right. Any question on determining the value, what we use the property profile for, the AVM? Any question on that? And what I showed you, we have very detailed step-by-step instruction along with screenshots. And what I told you, we take the estimated value from the property profile, we take the assessed value from the property profile, and then we also take the AVM. And then between those three, we would give an educated guess of what the value is going to be. If you're a real estate agent, you have way more powerful tools than we do as a loan officer, because here at ERS we promote earning through real estate, mortgage, and also insurance. So if you have the comparative market analysis CMA tool, you guys will probably get a closer value. This is more for loan officers that are not real estate agent. Okay. So owner search is something that we do in that same screenshot. So if I went back to my title profile, and I go back to start a new search. And the weird thing on this thing is there's nowhere but to hit back. So when you hit back, you would go to, you can go to this place here and hit owner search. So in this case, what I would do is put the last name, and the last name, since I have the property profile, I have the last name as Chan, Carolyn, and always last name first, okay, so we have Chan, Carolyn. I would look up Chan, and here, and I would probably put Carolyn because that's the name. And the county, you want to put it in the county because most likely, you don't want to do that, expand it throughout the state. So we hit submit request, and it can tell me that this person not only owns the property at where we found this, the McCarthy Way, we found they own, and you can see the name matches, that they own another property. Why is this important? This is important because if on the loan application they said they don't own any property and you're doing the loan and then you're leaving out the mortgage payment and they're right at the 42, 43, or 49% debt to income ratio, this does matter. It might kill the deal. And if they're not filing rental income, it won't show up in the tax return. There's a lot of places that it might not show up. So do the owner search. Make sure that you find out that they own any of the properties. Back in the days when we had stated income loans, we would have wage earner working for a restaurant making $15,000 a month. I mean, and then that's where the saying kind of is, buyers are liars. So with that saying, we take it with the property too. So we just run the owner search to figure out that we account for every single property that they own. Okay. All right, and the last thing I think we're going to cover today is called the loan lookup. What is the loan lookup? The loan lookup is for HARP loan, which is when you owe more than what the house is worth. If they owe more than what it's worth, it has to be owned by Fannie Mae or Freddie Mac in order for us to do the loan or the lender to do the loan. And how do you find out is you go to these websites. If you don't remember the website, it's okay. It's very simple to look up. If you go to any website and just type in Fannie Mae loan lookup, you'll find it right here on the first one. This is paid advertisement. So this one here, if you go here, you will need the borrower's last four digits of the Social Security number in order to find if they're eligible. So you get the first name, last name, the address, and be careful when you do the address. Click on this here. Whoops. If you hover over here, it said enter the address only, and if it's a unit, don't put it there. Some of them will say omit the drive. I think under Freddie Mac it tells you to do that. So you type in Freddie Mac loan lookup. It will take you here. And on here, it'll say do not include street, avenue, drive, and so forth. And where you would put that is here. You would put it on the bottom here. Okay. So pay attention to how they want you to put in the street, because if you enter it wrong and it come back, not being eligible, it's just because your address was wrong and another loan officer might have picked up that deal after you turned them down. So make sure you follow that there. If they are hesitant to give you the last four digits of your Social Security number, what you want to do is say, I can do it for you, but if you don't feel comfortable, give me the last four. I can email you the link, and you can look it up yourself. So just copy this link here and copy this link here, email it to them, and have them look for it themselves. And if they don't have a PDF thing, tell them to download Google for free. And when they hit the print, kind of show them to change the destination and put save as PDF. And they can email it to you after that. Okay. All right, so that's the loan lookup. When you're doing refinance, it doesn't apply at all to the purchase, but if somebody owes more than what the house is worth, it's considered, the terminology is underwater. If you want to see if you can help them, look it up here. That's step one. The second step is you want to make sure that the date that it was acquired by Fannie Mae and Freddie Mac is on or before May 31st, 2009. Okay, so on or before May 31st, 2009. If it isn't, then it's not eligible. And there's a recent rule just recently last year. It doesn't have to be sold. So if you find a date on there that said June 30th, 2009, it doesn't necessarily mean that they're eligible. You just need to get a copy of the mortgage note from them that shows March 31st or 2009 or earlier, and Fannie Mae and Freddie Mac will honor and allow that to happen. So you need a note, okay? So some people will say, well, I'm positive I refinance on, before that date. The gap is a lender can hang on to that file and not package it because they might not have enough volume to bulk it together, and they might not sell it until 3, 6, 9 months later. Okay. All right. I know we covered a lot. I went over a little bit because I started a little bit late, but it is 2 hours as far as the video is concerned. Right now, I'd like to kind of open it up to see if you guys have any question. If not, then we'll continue it, next week. So next week we'll be covering this. Let's see here. So next week's syllabus, we will continue. We will talk about pricing a loan using Loan Shifter and how to prepare an initial fee worksheet, which is like the loan breakdown or the loan option. All right, and we'll cover quite a bit of other things on how to run DO and so forth. All right, guys, I'm going to hang out for another 5 minutes, then I'm out of here. Thank you so much for joining us, and then I'll be here for 5 minutes. Feel free to ask any question. Thank you, guys. Have a good night.